Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, Tesla plows $2 billion into xAI. Tesla's electric vehicle sales collapsed, down 16% in the fourth quarter alone, down 9% for the full year. The company sold 1.64 million vehicles in 2025. China's BYD sold 2.26 million. Tesla lost its position as the world's #1 electric vehicle maker. And the company's response? Musk is turning his attention to artificial intelligence and robotics. Tesla is putting the electric vehicle business on the back burner. Tesla just approved a $1 trillion compensation package for Musk. $1 trillion. This is a capital allocation story about a founder who's abandoning the business that made him a legend to chase a new vision. And it's a story about a board that's willing to approve massive compensation packages despite deteriorating business performance. Let me explain what's happening at Tesla and why this matters. Tesla built the modern electric vehicle industry. Tesla proved that EVs could be desirable, profitable, and worth buying. Tesla created the brand equity in electric vehicles. For years, when people thought of electric vehicles, they thought of Tesla. Tesla was synonymous with EV. That dominance is gone. BYD now sells more electric vehicles than Tesla. BYD sells 2.26 million EVs. Tesla sells 1.64 million. That's a 620,000 vehicle gap. That's a 45% advantage for BYD. How did Tesla lose the EV crown? Several reasons. First, competition. When Tesla proved the market worked, every major automaker entered the space. Ford, General Motors, Volkswagen, BMW, Mercedes, all competing for EV market share. The market is no longer dominated by Tesla. The market is contested by dozens of competitors. Second, Tesla's vehicle lineup is aging. The company has been selling the same vehicles, Model S, Model 3, Model Y, Model X, for years. The company has promised a low-cost model for years. Finally, in the fall, Tesla released stripped-down versions of the Model Y and Model 3. But the stripped-down cars still cost more than the higher amenity versions cost. When customers could get the $7,500 federal tax credit, that credit expired in September. So the stripped-down cars are less competitive, not more. Third, government subsidies expired. The federal tax credit of $7,500 for EV purchases expired. That credit was crucial for EV adoption. Without it, consumers are comparing unsubsidized EV prices to unsubsidized internal combustion engine prices. And the EVs are more expensive. Demand is softer. Fourth, Tesla's reputation has been damaged. Elon Musk embraced partisan politics in 2024. That brought protests and worsened Tesla's reputation in regions where Tesla was once popular: California, Europe. When the CEO becomes politically divisive, the brand suffers. Customers care where they buy from. So Tesla's EV business is struggling. Sales are down. Market share is down. Competition is fierce. The tailwind from government subsidies is gone. What is Musk doing? He's pivoting. He's shifting his focus to artificial intelligence and robotics. Tesla just invested $2 billion in Musk's xAI company. $2 billion. That's capital that could be invested in new EV models, in production capacity, in competing with BYD. Instead, it's going to AI. Musk says Tesla will pivot from selling electric vehicles to providing a service model. Robotaxi rides. Autonomous vehicles. AI-powered mobility. The vision is that Tesla will eventually make more cybercabs, fully autonomous two-seaters with no steering wheel or pedals, than all of its other vehicles combined. That's an audacious vision. That's a complete reimagining of the business. From selling cars to providing robot taxi services powered by AI, it's a bet that the future of transportation is not owning vehicles, but hailing autonomous vehicles. It's a bet that Tesla can build autonomous vehicles better than Alphabet's Waymo, better than Cruise, better than any other competitor. And it might work. But it's also a massive bet that diverts capital and focus from the core business that's currently struggling. Here's the capital allocation question. Why is Tesla investing in xAI and robotics while the EV business is collapsing? Why not fix the core business first? The answer might be that Musk doesn't believe the core business is fixable. Musk might believe that electric vehicles have become commoditized. Every major automaker now makes EVs. The market is competitive, margins are compressing. The business is mature, so Musk is looking for the next growth opportunity. Musk is betting that autonomous vehicles and robotaxis are the future. Musk is betting that Tesla can build better AI and robotics than anyone else. That's an aggressive bet. That's a bet that says the EV business is done. Let's move on to the next thing. The board is supporting this. In November, Tesla shareholders approved a new compensation package for Musk worth as much as $1 trillion. $1 trillion. Over a 10-year period if Musk meets a series of performance goals. Let me be clear about what that means. The board is saying, we believe Musk is worth $1 trillion over the next decade. That's roughly $80 billion per year. That's more than Tesla's annual profit. That's one of the largest compensation packages ever awarded to an executive. The board's justification is that the package is necessary to keep Musk engaged at the company as it transforms from selling EVs to focusing on AI and robotics. On screen, you're seeing Tesla's financial performance. Quarterly net profit in the fourth quarter was $840 million, down from $1.87 billion a year ago. That's a 55% decline in quarterly profit. Earnings per share were 50 cents, beating analyst expectations of 45 cents. But the underlying profit is clearly declining. Revenue fell 3% in the fourth quarter to $24.9 billion. Full-year revenue was $94.8 billion, down 3% from the year before. The company is generating less revenue despite being worth hundreds of billions of dollars. Look at the stock performance on screen. Over the past year, Tesla shares are down roughly 20% compared to the S&P 500. Up. Tesla is underperforming the market significantly. Free cash flow was $1.4 billion for the quarter, down 30% from a year earlier. The company is generating less cash despite massive revenue. Why? Because Tesla is investing heavily in research and development in robotics and artificial intelligence. So here's what's happening. Tesla's EV business is declining. Revenue is down. Profit is down. Market share is down. But the company is investing billions into AI and robotics. The company is diverting capital away from the struggling core business to fund a speculative transformation. And the board is rewarding Musk with a $1 trillion package to stick around and execute this transformation. Now let me talk about the realistic assessment of Tesla's path. Tesla's full self-driving supervised software has 1.1 million subscribers. The company says it will make vehicles fully autonomous one day. But the technology is not there yet. Autonomous vehicles are harder than everyone thought. Tesla has been promising autonomous driving for years. The technology is not ready. Waymo, which is owned by Alphabet and has massive AI capabilities, is operating autonomous taxi services in limited cities. But even Waymo is moving slowly. The technology is difficult. The regulatory environment is uncertain. The liability questions are unresolved. Musk says Tesla will start production on the Cybercab, a fully autonomous two-seater with no steering wheel or pedals, in April. That's a 5-month time frame from now. That's aggressive. That's optimistic. Given Tesla's track record of missing timelines on new vehicle launches, I would be skeptical of that timeline. But let's assume Musk is right. Let's assume the Cybercab launches in April and is fully autonomous. How many will Tesla sell? How much margin will Tesla earn? At what price? The business model doesn't exist yet. The regulatory environment hasn't been determined. The customer adoption is uncertain. Musk is asking shareholders to approve a $1 trillion compensation package based on a business model that doesn't exist yet. Here's the uncomfortable reality. The EV business that made Tesla is collapsing. Sales are down. Market share is gone. Competition is fierce. And Musk is not fixing the EV business. Musk is pivoting away from it. That might be the right strategic move. Maybe the EV business is mature and not worth the effort. Maybe robotaxis and autonomous vehicles are the real future. But it's also a massive risk. Tesla is betting the company on a transformation that's unproven, undeveloped, and years away from monetization. Meanwhile, the core business is struggling. Let me extract 3 timeless lessons from Tesla's situation. First, when a founder becomes convinced that the core business is mature and the future lies elsewhere, massive capital allocation mistakes become likely. Musk has become convinced that electric vehicles are commoditized and that robotaxis and AI are the future. Based on that conviction, Musk is diverting capital away from the EV business and into AI and robotics. That's a decision that could prove right or catastrophically wrong. The lesson is, be skeptical when a founder pivots away from a struggling core business to chase a new vision. Usually, the right move is to fix the core business first. Pivoting away often signals that the founder has given up on the core business, rather than being committed to fixing it. Second, massive compensation packages approved during periods of declining business performance are a red flag for shareholder value destruction. The board approved a $1 trillion package for Musk while Tesla's profit is declining, revenue is declining, and market share is collapsing. That's a compensation decision made to keep a founder engaged rather than to align the founder's incentives with shareholder interests. The lesson is, massive compensation packages are most likely to destroy shareholder value when they're approved, despite deteriorating business performance. They're a sign that the board is trying to keep the founder happy rather than trying to optimize for shareholder returns. Third, transformational bets away from a struggling core business are most likely to fail because they lack the focus and capital required to succeed. Tesla is trying to transform from an EV maker to an autonomous vehicle and robotaxi company, while the EV business is collapsing. That's a difficult transformation to execute while managing a failing core business. Usually, transformations succeed when a company has a strong, profitable core business that can fund the transformation. When the core business is weak, the transformation often fails because the company doesn't have the resources or focus to pull it off. Tesla's transformation might be an exception, but history suggests the odds are against it. Here's my closing conviction. Tesla is at an inflection point. The company that dominated the EV industry is losing market share to BYD and other competitors. The company that was synonymous with innovation has an aging vehicle lineup. The company that was built by Musk's vision is now pivoting away from that vision to chase autonomous vehicles and robotaxis. The board is supporting this pivot by approving a $1 trillion compensation package. That's a vote of confidence in Musk's vision. But it's also a massive bet with shareholder capital that Musk's new vision will work out. If the transformation succeeds, if Tesla builds autonomous vehicles and robotaxis that dominate the market, then the decision will look brilliant. But if the transformation fails, if autonomous vehicles don't mature as quickly as Musk believes, if competitors like Waymo succeed before Tesla, if the regulatory environment prevents robotaxis from becoming mainstream, then Tesla will have wasted years and billions of dollars, while its core EV business collapsed. The question is not whether Musk is intelligent or visionary. Musk is both. The question is whether pivoting away from a struggling core business to chase a speculative transformation is the right capital allocation decision. History suggests it's a high-risk bet. And history also suggests that $1 trillion compensation packages approved during periods of declining performance are rarely good for shareholders. Here's the sentence you'll remember. When a legendary founder decides the business that made him famous is obsolete and pivots to chase a new vision, shareholders should hope the new vision works out, because there's no backup plan. Moving to next title. Here's what happens when you go off weight loss. Drug. Serena Williams appears in a telehealth ad saying, if you're carrying 15 to 20 extra pounds, medications like Wegovy can help jumpstart your progress. That's the marketing message. Jumpstart your progress, take the drug, lose the weight, move on with your life. But that's not how these drugs work. That's the opposite of how they work. Wegovy, Ozempic, Mounjaro, Zepbound. They're called GLP-1 drugs. They mimic naturally occurring gut hormones. They suppress appetite. They make you feel full faster. They work while you're taking them. But studies show that after you stop taking them, people regain lost weight within about 1.5 years. And any improvements in blood sugar, blood pressure, or cholesterol are reversed. People who take GLP-1s regain weight 4 times faster than those who lose weight through lifestyle changes. This is a story about the disconnect between how these drugs are marketed and what they actually do. It's a story about capital allocation decisions made by patients who are buying a promise of sustained weight loss when they're actually buying a temporary suppression of appetite. And it's a story about how nearly half of all patients who start these drugs will stop taking them within a year without understanding what comes next. Let me explain the mechanism and why this matters for understanding how incentives and marketing shape consumer behavior. GLP-1 drugs are blockbuster medications. They're prescribed for weight loss and to treat type 2 diabetes and obesity, chronic diseases. That distinction is critical. Nearly 18% of U.S. adults have taken a GLP-1 drug. That's about 58 million people. But the marketing is increasingly positioning these drugs as lifestyle fixes. Take the drug. Lose weight. Stop. Done. But obesity and type 2 diabetes are chronic diseases. That means lifelong management. Chronic diseases require ongoing treatment. When you stop treating a chronic disease, the disease returns. Here's an analogy that doctors use. When you stop taking a statin for high cholesterol, the cholesterol goes back up. When you stop taking insulin for diabetes, diabetes returns. The disease doesn't go away because you stop taking the medication. The same is true for obesity. Obesity is a chronic disease driven by metabolic adaptation. The body's survival mechanism evolved over centuries to conserve energy during famine. When you take a GLP-1 and lose weight, your body responds by increasing hunger and appetite to restore the weight you lost. While you're on the drug suppresses that appetite signal. You feel full, you eat less, you lose weight. But the moment you stop taking the drug, the appetite signal roars back with intensity. A researcher from the University of Oxford, named Sam West, led a review published in the British Medical Journal that examined 37 studies of weight loss medications. The findings were stark. On average, people taking a GLP-1 lost 32 pounds while on the medication, but in the first year after stopping, they gained back 21 pounds. That's a 66% rebound. People who lost weight through behavioral changes, diet and exercise, took on average 4 years to return to baseline weight. The GLP-1 users regained weight 4 times faster. 4 times. On screen right now, you're seeing that comparison. On the left, GLP-1 users losing 32 pounds, then regaining 21 in year 1. On the right, behavioral weight loss, taking 4 years to return to baseline. The GLP-1 rebound is exponentially faster. Why? Because stopping a behavioral intervention is gradual. When someone stops dieting, they don't go from restricting calories to eating without limits. They gradually increase food intake. The body adapts gradually. But with GLP-1s, the mechanism is different. The drug interferes with the body's appetite control system. While you're on the drug, your appetite is suppressed unnaturally. The moment you stop, your appetite doesn't return to normal. It returns at a heightened level. Kevin Hall is a former senior investigator at the National Institutes of Health. He's documented this phenomenon. He says, these drugs, they interfere with that feedback control system while you're on them, but once you're off the drugs and lost so much weight, your appetite is much higher than it was to begin with, so you'll be overeating calories. The appetite is higher than baseline because the body perceives itself as having been underfed while on the medication. The body compensates by increasing hunger and driving weight regain. So here's the capital allocation question. Are these drugs worth starting if you can't stay on them long term? Nearly half of patients stop taking GLP-1s within a year. Half. That means for 50% of patients, the drug is a 1-year experiment that results in massive weight regain, reversed health improvements, and a body composition worse than before. Because when you regain weight, you regain more fat and less muscle than you lost. Dr. Robert Kushner is an obesity medicine specialist at Northwestern University. He says he's only had a handful of patients who were able to keep weight off long-term after stopping a GLP-1. A handful. Out of presumably hundreds or thousands of patients. Kushner tells patients who want to take GLP-1s short-term, I would never say to them there's no point in starting, but I will tell them right up front we have to start thinking of the day after stopping now. That's the key insight. The real question is not, will this drug help me lose weight? The real question is, what happens after I stop? And the answer, according to the data, is you regain most of the weight within a year and a half, you're left with worse body composition, your health markers return to baseline, and you're psychologically devastated by the weight regain. The depressing results raise an uncomfortable question. Are these drugs worth starting at all? Doctors largely say yes, but with a massive caveat. You need a long-term strategy. You need to combine medication with lifestyle changes. You need ongoing counseling. You need to plan for long-term management, not short-term weight loss. Dr. Gitanjali Srivastava, medical director of obesity medicine at Vanderbilt University, says, we really need to provide these therapies in combination all in one for the maximum benefit of the patient. But that's not how these drugs are being marketed. Serena Williams in the ad is not saying, "This medication is part of a lifelong obesity management strategy that requires ongoing treatment, counseling, and behavioral change." She's saying, if you're carrying 15 to 20 extra pounds, medications like Wegovy can help jumpstart your progress. That messaging is fundamentally misleading. It positions the drug as a tool to achieve a temporary goal, losing 15 to 20 pounds, when the drug is actually designed for chronic disease management. Here's what's really happening. Pharmaceutical companies have created effective medications for chronic diseases. These medications work. They suppress appetite. They enable weight loss. But the market for chronic disease management is limited. Chronic diseases require long-term commitment and ongoing pharmaceutical spending. So the companies are marketing these drugs differently. They're marketing them as lifestyle fixes. Jumpstart your progress. Get back to your goal weight. The messaging implies, take this short-term fix and you're done. But the data shows the opposite. Without long-term treatment and behavioral change, nearly every patient regains weight within a year and a half. The capital allocation mistake is patient level. Nearly 18% of American adults have tried these drugs. Many have paid out of pocket or used insurance coverage, expecting to lose weight permanently. But half will stop taking the drug within a year, regain the weight, and be left disappointed. The pharmaceutical companies have made a smart capital allocation decision. Create effective drugs, market them as lifestyle fixes, expect high discontinuation rates, but monetize the patients who stay on the drugs long-term and the repeat customers who cycle on and off. The patients have made a poor capital allocation decision. Spend money on a medication expecting permanent weight loss when the data shows the weight loss is temporary unless medication is continued indefinitely. There's also a body composition issue. When you lose weight on a GLP-1, you lose a mix of muscle and fat. When you regain weight, you regain mostly fat. So even if you regain the same amount of weight, your body composition is worse. You have less muscle and more fat than before you started. Dr. Robert Kushner says the psychological impact is real. In addition to your appetite roaring back, there is also the psychological impact of gaining weight back, which can lead to people feeling defeated and less likely to exercise. So the patient who loses 30 pounds on Wegovy, stops taking it, regains 21 pounds in a year, is left with worse body composition, higher appetite, and psychological defeat. That's not a success. That's a failure with additional emotional damage. The depressing part is that the data suggests there's actually value in taking these drugs. If you take them as prescribed, understand their chronic treatments, and commit to long-term management. But the marketing, the messaging, and the business model are all built around the assumption that patients want a short-term fix. Let me extract 3 timeless lessons from this GLP-1 story. First, marketing that separates the product from its actual use case destroys consumer value. Pharmaceutical companies are marketing GLP-1s as weight loss medications for people carrying 15 to 20 extra pounds, when the drugs are designed for chronic disease management in obese and diabetic populations. That marketing works for pharmaceutical companies. It expands the addressable market, but it's destructive for consumers who expect temporary weight loss and instead get a lifestyle-dependent medication. The lesson is, be skeptical of products marketed for outcomes they're not designed to deliver. The marketing message that seems most compelling is often the one most likely to disappoint. Second, chronic disease management requires long-term commitment, but markets prefer to sell short-term fixes. Obesity is a chronic disease. Type 2 diabetes is a chronic disease. These require long-term medication, behavioral change, and ongoing medical management. But the market, both pharmaceutical companies and patients, prefers to think of them as temporary problems that can be fixed with short-term interventions. The data shows this is wrong. The lesson is, when a condition is chronic, treatment must be chronic. There's no shortcut. Marketing that implies otherwise is dishonest, and buying products based on that marketing is a poor capital allocation decision. Third, capital allocation failures happen when the decision maker doesn't understand the time horizon and commitment required. Nearly half of GLP-1 patients stop taking the drug within a year. They've allocated capital, money, and hope to a treatment they can't sustain. The lesson is, before spending money on anything, understand the full cost and full timeline of commitment. With GLP-1s, That means understanding you're buying a chronic disease management strategy, not a temporary weight loss solution. With investments, it means understanding the time horizon and ongoing costs before deploying capital. Here's my closing conviction. GLP-1 drugs are remarkable medications. They work. They suppress appetite. They enable weight loss. They improve health markers. They're transformative for patients who commit to long-term treatment and behavioral change. But they're being sold as something they're not. They're being sold as lifestyle fixes when they're actually chronic disease treatments. That marketing disconnect is destroying consumer value at scale. Nearly 18% of American adults have tried these drugs. Roughly half have stopped within a year. Millions of people have spent money expecting permanent weight loss and instead gotten a temporary suppression of appetite that reverses the moment the medication stops. The pharmaceutical companies have built a business model around that disconnect. Create effective drugs, market them as short-term fixes, monetize the long-term users, replace the discontinued users with new patients. The patients have made the opposite mistake. They've allocated capital based on marketing messaging that doesn't reflect reality. The data is clear. These drugs only work while you take them. The moment you stop, weight regain begins immediately. Long-term success requires long-term commitment to medication and behavioral change. That's not a criticism of the drugs. That's a reality of chronic disease management. But it's a massive failure of marketing and patient education. Here's the sentence you'll remember. When a medication is marketed as a short-term fix for a chronic disease, you're not seeing innovation. You're seeing a company optimize for sales while sacrificing patient outcomes. Moving to next title, we're planning for the wrong AI job disruption. Washington is bracing for an artificial intelligence employment shock that is unlikely to arrive. And so the government risks spending billions of dollars preparing for the wrong problem entirely. This is a story about how policymakers misunderstand technology, how metrics get mistranslated into forecasts, and how political panic destroys billions of dollars in potential economic value. Let me explain what's happening and why it matters. In 2023, Goldman Sachs published an estimate that roughly 300 million jobs worldwide are exposed to generative AI. 300 million jobs. Headlines around the world treated this figure as a prediction. AI will eliminate 300 million jobs. Policymakers panicked. Congress is now racing to fund broad AI retraining initiatives. The premise is that mass white-collar layoffs are imminent. The assumption is that if AI can perform some of a job's tasks, the job will disappear. But that's not what the Goldman Sachs figure says. And that's where the misunderstanding begins. The Goldman Sachs estimate is derived from occupational task lists. It asks, can an AI system perform some portion of employees' current tasks? Summarizing documents, drafting routine text, coding standard functions, analyzing familiar datasets. Many politicians and commentators have assumed that if AI can perform some of a job's tasks, the job will vanish. That assumption is wrong, and it's costing billions of dollars in wasted policy. Here's the distinction that matters. Task reordering is not job destruction. When technology lowers the cost of performing specific tasks by lifting some of the load, firms reorganize production. Workers specialize differently. Demand expands in ways that task-based rankings don't capture. Consider a paralegal. A paralegal's job includes summarizing depositions, reviewing contracts, organizing discovery. In a task-based ranking, the paralegal might score as highly exposed to AI automation. But automating first-pass document review doesn't eliminate the paralegal's job. It reorganizes it. The paralegal's work shifts from routine document scanning to higher-value work, flagging anomalies, managing client interactions. The paralegal becomes more valuable, not less. This pattern repeats across professions. In accounting, software has automated large portions of bookkeeping and tax preparation without eliminating accountants. Accountants have moved up the value chain toward advisory work, forensic work, judgment-intensive analysis. Demand for accountants hasn't fallen, it's risen. In nursing, AI tools increasingly handle documentation and monitoring alerts. Do nurses disappear? No. Nurses spend more time on direct patient care rather than replacing them. Patient outcomes improve, demand for experienced nurses increases. In software development, developers routinely use AI tools to generate boilerplate code, test functions, debug routines, tasks that once consumed hours. The result isn't fewer developers, It's developers producing more complex systems faster. Demand for experienced developers has risen, not fallen. This is the critical insight that politicians and policymakers are missing. Technology automates, accelerates, or reduces the cost of specific tasks within a job. It doesn't eliminate the job. It allows employees to spend more time on higher value activities. Output expands. Wages often rise. A job that scores as 40% exposed to AI in task-based rankings doesn't have a 40% chance of vanishing. It's more likely to be reorganized. The 40% of tasks that can be automated shift to the machine. The 60% of judgment-intensive, relationship-intensive, domain-specific work remains with the human. Here's what's remarkable. As technology accelerates tasks and reduces costs, companies create roles that task-based rankings cannot see because they don't exist yet. Law firms increasingly rely on litigation support managers and AI review specialists who oversee automated document analysis. These are new roles. They exist because of how AI reorganizes work. Accounting firms have expanded their roles in data assurance, model oversight, advisory services. These roles sit alongside automated reporting. They're new roles created by AI reorganization. In software teams, engineers now specialize in system architecture, model integration, quality control, roles that expand as routine coding becomes automated. These are new roles. In healthcare, AI-assisted documentation has increased demand for employees who can lead clinical operations by managing data flows, compliance, workflow design. These are new roles created by AI. Task-based rankings from Goldman Sachs and the OECD cannot see these roles because they don't exist in historical job classifications. But they exist because of how technology reorganizes work. Now here's where the capital allocation disaster begins. Policymakers' misunderstanding of this dynamic is jeopardizing enormous gains. Washington is racing to fund broad AI retraining initiatives on the premise that occupational collapse is imminent. Federal workforce initiatives are increasingly assuming occupational destruction rather than within-job adaptation. But if AI primarily augments tasks rather than replaces jobs, this approach misses the target entirely. Workers don't need to be rescued from their professions. They need room to adapt within them. Large-scale retraining programs have a mixed record even when displacement is real. When displacement is overstated, when you're preparing for a problem that won't materialize, these programs risk doing significant harm. They pull workers out of productive roles. They subsidize credentials with little demonstrated labor market value. They signal panic to firms and households. That panic becomes self-reinforcing. Companies delay hiring because they fear workforce collapse. Workers delay investing in firm-specific skills because they fear their industry is collapsing. Productivity-enhancing reorganization slows. The result is a policy-induced drag on growth and adaptation. You're wasting billions of dollars preparing for mass layoffs that won't happen. In the process, you're actually slowing the reorganization that makes AI a net benefit for employment. Let me be clear about what task-based rankings actually measure. They measure task susceptibility. They answer this question: what percentage of a job's tasks can an AI system perform? They do not answer this question: what percentage of the job will be eliminated? Goldman Sachs and the OECD explicitly caution in their reports that measures of AI exposure describe task susceptibility, not forecasts of job loss. But politicians and commentators have repurposed these metrics as if they're unemployment forecasts. That's a misuse of the data. The distinction between task reordering and job destruction is not semantic. It is economic. It is the difference between workers adapting within their professions and workers being displaced from entire industries. History suggests the opposite of what policymakers fear will happen. AI is likely to increase the productivity and wages of many of these roles long before it eliminates them. Task automation typically reorganizes work well before it destroys jobs, if it does the latter at all. Now, is there any role for retraining at all? Yes, but only if it's targeted. While AI won't destroy occupations in the manner politicians imagine, some workers will adapt more easily than others. AI rewards those with judgment, domain knowledge, and the ability to understand machine output. It penalizes those in rigidly designed jobs, narrowly scripted clerical work, call center scripts, rigid workflows. Blanket retraining schemes don't account for these nuances. A general retraining program treats everyone as if they need to escape their profession. But most workers don't. Most workers need support adapting within their professions. The real danger isn't that AI will eliminate work faster than society can adapt. The real danger is that governments will intervene where they shouldn't and neglect where they should help. Let me extract 3 timeless lessons from this policy failure. First, task-based metrics are descriptive, not predictive. When descriptive metrics are repurposed as forecasts, policy failures follow. Goldman Sachs' study describes which tasks AI can perform. It doesn't forecast job losses. But policymakers treated it as a job loss forecast and built trillion-dollar policy programs on that misreading. The lesson is, be skeptical of any policy that treats a descriptive metric as a predictive forecast. Descriptive and predictive are fundamentally different questions. Confusing them leads to massive capital misallocation. Second, when politicians panic about technological disruption, they typically misprioritize policy and waste capital on preventing the wrong problem. Washington is spending billions to prevent mass white-collar layoffs that historical evidence suggests won't materialize. Meanwhile, the real problem, workers needing support to adapt within their changing professions, is being neglected. The lesson is, panic-driven policy is almost always wrong. Take time to understand the actual problem before committing billions of dollars to solving an imagined problem. Third, large-scale interventions based on false premises can actually slow the beneficial adaptation they're meant to prevent. By signaling panic about AI eliminating jobs, the government is causing companies to delay hiring and workers to doubt their future. That panic itself becomes self-reinforcing and slows productivity-enhancing reorganization. The lesson is, sometimes the most damaging policy is well-intentioned intervention based on a fundamental misunderstanding of how markets and technology actually work. Here's my closing conviction. AI will disrupt labor markets, that's certain. But disruption is not synonymous with destruction. The real question isn't whether AI will cause job losses. The real question is whether governments will intervene in ways that make the transition smoother, or whether they'll intervene in ways that slow adaptation and waste capital. History suggests that technology reorganizes work well before it destroys jobs. Accountants didn't disappear when accounting software automated bookkeeping. Nurses didn't disappear when electronic health records automated documentation. Software developers didn't disappear when AI tools automated boilerplate code. In each case, the profession evolved. Workers moved up the value chain. Output increased. Demand rose. The same pattern will likely repeat with AI. Some tasks will be automated. Workers will reorganize. New roles will be created that don't exist in today's job classifications. Some workers will struggle to adapt, but that's an argument for targeted, profession-specific support, not blanket retraining programs. Washington is preparing for a massive white-collar employment collapse. History suggests that's the wrong problem. The actual problem is that workers will need support adapting within their professions as those professions reorganize around AI tools. By building policy around the wrong forecast, the government risks wasting billions of dollars only to slow the adaptation that makes technological change a net positive for jobs and wages. Here's the sentence you'll remember. When governments panic about technological disruption and build policy around task-based metrics they've mistaken for job loss forecasts, they almost always make things worse while believing they're making them better. Moving to next title, Microsoft taps view as outlays surprise investors. Microsoft just reported $81.3 billion in revenue. The company beat earnings expectations. Azure cloud business grew 39%. Net income hit $38.5 billion. The company crushed the numbers, and Microsoft stock fell 6% in after-hours trading. This is a capital allocation story about a company that's winning in artificial intelligence, but spending so much money on infrastructure that investors are questioning whether the business will ever be profitable at the scale required. Let me explain what Microsoft is doing and why the market is panicking despite stellar earnings. Satya Nadella is the CEO of Microsoft. For years, Nadella's strategy has been to position Microsoft as the cloud computing company and the AI company. Microsoft partnered with OpenAI. Microsoft invested billions into OpenAI. Microsoft is building the cloud infrastructure that powers OpenAI's ChatGPT and other AI models. The thesis was, AI demand will be enormous. Cloud demand will be massive. Microsoft will own the infrastructure. The company will print money. For a while, that thesis worked. Azure grew 49% at one point. AI adoption was accelerating. Enterprise demand was surging. Customers wanted access to AI capabilities. Microsoft was positioned as the supplier. But something has changed, and it's visible in the capital allocation decisions Microsoft is making. Microsoft just spent $37.5 billion on capital expenditures. That's money spent on data centers, AI infrastructure, computing equipment. That's more than analysts expected. That's a massive number. For context, that's nearly 50% of the company's annual net income spent on infrastructure in a single quarter, and the company is saying it will need even more. Even with the new investments, Microsoft says it needs more capacity to meet growing demand. Azure grew 39%. That's good. That's strong growth. But here's the problem. Azure growth matched Wall Street expectations, but it was lower than the previous quarter. Growth is slowing. The company's CFO, Amy Hood, told investors that limited availability of AI hardware is impacting how quickly Microsoft's cloud business can grow. The hardware scarcity is capping Azure's revenue potential, and growth could slow further in the current quarter. So here's the capital allocation question. Why is Microsoft spending $37.5 billion on data center infrastructure when the growth rate is declining and hardware availability is already a constraint? The answer is that Microsoft believes the constraint is temporary. Microsoft believes that if the company builds the capacity, the demand will come. Microsoft is betting that the demand for AI infrastructure will remain so strong that even with massive build-outs, the company won't have enough capacity. But that's a massive bet. That's a bet that says, spend $37.5 billion this quarter. Spend more next quarter. Build data centers around the world. Assume the demand will be there. If the demand materializes, Microsoft wins. If the demand doesn't materialize at the expected pace, Microsoft has spent tens of billions of dollars on infrastructure that's generating lower returns than expected. On screen right now, you're seeing Microsoft's capital expenditure trajectory. In recent quarters, the company has ramped spending dramatically. $37.5 billion in the most recent quarter. That's not a one-time number. That's the new baseline. The company is spending at a run rate of $150 billion annually on data centers and AI infrastructure. For context, that's more than the entire annual revenue of most Fortune 500 companies. That's more than the GDP of most countries. That's an enormous commitment of capital. Now here's where the profitability question becomes critical. Azure is growing 39%. That sounds great, but let me do the math. If Azure is growing 39%, and the company is spending $150 billion annually on infrastructure to support that growth, what's the return on that capital? Typically, cloud infrastructure generates returns measured in years or decades. A data center costs billions of dollars to build. That data center then generates revenue over 10, 15, 20 years. The return on that capital is the spread between the revenue generated and the cost of that infrastructure. If revenue is growing at 39%, but the growth rate is slowing, and capital spending is growing at a much faster rate, then the returns on new capital are declining. This is the classic capital allocation trap. Early on, capital is invested at high returns. New data centers generate strong revenue growth. But as the business scales, each new dollar of capital generates lower returns. At some point, the returns on incremental capital equal the cost of capital. Beyond that point, the company is destroying value by investing. Microsoft might be approaching that point. Here's another issue that's not being discussed enough. Microsoft's net income was boosted by $7.6 billion from OpenAI. That's not cloud revenue. That's not Azure revenue. That's accounting gains on Microsoft's stake in OpenAI. Without the OpenAI boost, Microsoft's core cloud business looks less impressive. The company is spending enormous amounts on infrastructure. Azure is growing at a slowing rate, and a significant portion of the net income boost comes from OpenAI accounting gains, not from cloud operations. Let me talk about the OpenAI dependency. Microsoft disclosed for the first time that about 45% of its remaining cloud commitments are from OpenAI. 45%. That means nearly half of Microsoft's future revenue is committed to one customer, OpenAI. That's a massive concentration risk. If OpenAI's AI model development slows, if OpenAI gets acquired, if OpenAI's business model changes, Microsoft loses 45% of its committed cloud revenue. Microsoft owns roughly 27% of the for-profit OpenAI entity. That means Microsoft has some influence. But it also means Microsoft is betting enormous amounts of capital on the success of a company Microsoft doesn't fully control. This is a capital allocation failure waiting to happen. Microsoft is spending tens of billions of dollars on data centers to support one customer that represents 45% of committed revenue. If that customer's growth slows, if that customer's needs change, Microsoft has overinvested in infrastructure. On screen right now, you're seeing the paradox. Microsoft beats earnings expectations. Net income is $38.5 billion. Azure grows 39%. But the stock falls because investors understand the underlying reality. The company is spending capital at a rate that may not generate adequate returns, and the growth rate is slowing. The company's CFO says Azure growth could slow in the current quarter. That means the company is investing at an accelerating rate while growth is decelerating. That's the opposite of good capital allocation. Here's what's really happening. Microsoft CEO Nadella wrote in a blog post last month that AI capabilities have so far outpaced real-world impact. That's an important admission. AI is generating enormous hype, but the actual business impact is less clear. Nadella even warned that AI adoption needs to spread beyond the tech industry to avoid a financial bubble. That's a CEO warning that the AI bubble might be real. And yet Microsoft is spending $150 billion annually on data center infrastructure to support that potentially bubbling market. That's not capital allocation. That's panic spending. When a CEO says the AI boom might be a bubble, and simultaneously the company is spending record amounts on infrastructure to capture that potentially bubbling market, that's a disconnect. The market is correct to be nervous. Microsoft is winning in the short term. Azure is growing. Revenue is up. But the company is betting enormous amounts of capital on infrastructure that may generate inadequate returns if the AI growth rate slows or if the profitability of AI services declines. Let me extract 3 timeless lessons from Microsoft's capital allocation decisions. First, when capital spending accelerates faster than revenue growth, returns on incremental capital are declining. Microsoft is spending record amounts on infrastructure while cloud growth is slowing. That means each new dollar of capital is generating lower returns than the previous dollar. This is the classic trap. The business that generated high returns in the past can no longer generate those returns at scale. The lesson is, watch for the moment when capital spending growth exceeds revenue growth. That's the inflection point where the business model starts to break down. Microsoft might be at that inflection point. Second, customer concentration creates invisible capital allocation risk. 45% of Microsoft's remaining cloud commitments are from OpenAI. The company is building infrastructure to support one customer. If that customer's growth slows, if the business relationship changes, if OpenAI's needs shift, Microsoft has overinvested in capacity. The lesson is, concentration risk is invisible until it becomes catastrophic. Microsoft's executives didn't highlight the OpenAI concentration risk. Investors had to ask for the figure. That's when concentration becomes dangerous, when management isn't focused on it. Third, CEO warnings about bubbles combined with accelerating capital spending into that bubble are red flags. Nadella warned that AI adoption needs to spread beyond tech to avoid a bubble. Simultaneously, Microsoft is spending record amounts on AI infrastructure. That's a contradiction. Either the CEO believes in the growth and should be investing, or the CEO is worried about a bubble and should be cautious. Doing both at once is reckless. The lesson is, be skeptical when capital allocation doesn't match CEO commentary. If a CEO warns about a bubble, capital spending should slow. If capital spending accelerates, the CEO shouldn't be warning about bubbles. Here's my closing conviction. Microsoft is in the middle of the biggest capital allocation bet in the company's history. The company is spending $150 billion annually on data center infrastructure to support AI cloud demand. The bet is that demand will be enormous and sustained, but the data suggests otherwise. Azure growth is slowing. The company admits hardware scarcity is capping revenue potential. OpenAI represents 45% of cloud commitments, a massive concentration risk. And the CEO is warning that the AI industry might be in a bubble, yet the company continues to accelerate capital spending. This is not sustainable. At some point, returns on incremental capital will equal the cost of capital. Beyond that point, the company will be destroying shareholder value by investing. The market is correct to be nervous. Microsoft stock fell 6% because investors understand the underlying mathematics. The company is beating earnings expectations this quarter. But the capital allocation decisions being made today will determine profitability for the next decade. And those decisions suggest that Microsoft's management may be overestimating AI demand growth and underestimating the capital required to capture it. Here's the sentence you'll remember. When a company beats earnings while simultaneously spending capital faster than growth is accelerating, the stock fall isn't a mistake. It's the market pricing in the capital allocation. Moving to next title, LVMH results hit luxury sector. LVMH shares just fell nearly 8% in a single day after reporting that the fashion and leather goods division, Louis Vuitton, Dior, the crown jewels of the luxury world, saw organic sales decline 3%. That beat the consensus expectation of -1%. That beats consensus. And yet shares collapse. This is a story about success creating the conditions for competitive failure. This is a story about how the best business model in the world eventually plants the seeds of its own decline. Let me explain what happened and why it matters. Bernard Arnault is the founder and controlling shareholder of LVMH. He built the world's largest luxury goods conglomerate by doing something almost no one else has done successfully. He made luxury brands scalable. He created an empire that owns Louis Vuitton, Dior, Fendi, Givenchy, Celine, Christian Dior, Loro Piana, Salvatore Ferragamo, Hermes, Cartier, Bulgari, Tiffany, and dozens of other flagship luxury brands. Arnault's genius was not inventing luxury. His genius was systematizing luxury. He understood something fundamental. Luxury is not just about the product. Luxury is about psychological aspiration. It's about the idea that ordinary people can own a piece of something extraordinary. A middle-class consumer in Shanghai can save for 2 years to buy a Louis Vuitton bag. That consumer is not buying leather and craftsmanship. That consumer is buying status. Arnault built an empire on that insight. And for decades, it worked brilliantly. The strategy was simple. Acquire prestigious brands, position them as aspirational, ensure they maintain brand prestige, while simultaneously making them accessible enough that middle-income consumers feel they can save up and buy them. Keep the brand image pure through meticulous marketing and distribution control. Expand geographically into emerging markets where the middle class is growing and wealthy and aspirational. This worked. LVMH became the most valuable luxury conglomerate in the world. Sales grew. Margins were enormous. The business generated torrential cash flow. Shareholders got rich. Arnault got richer. But here's the thing about success. It plants the seeds of failure. The LVMH empire was built on a very specific assumption. There will always be a growing global middle class with disposable income and aspirational desire for luxury goods. But that assumption has broken. Let me show you the evidence. On screen right now, you're looking at LVMH's performance by division in the fourth quarter of 2025. Fashion and leather goods, the core division, down 3%. That's 6 consecutive quarters of decline. 6 quarters. Not a blip, a trend. That division houses Louis Vuitton, Dior, Givenchy, Celine. These are not struggling brands. These are iconic brands. Yet sales are falling. Consecutive quarters of contraction tell you something has structurally changed in the market. Wine and spirits division, down 9%. Cognac is getting hit. Cognac used to be the drink of luxury. Now middle-income consumers in China and America are trading down to cheaper alcohol brands. That's the canary in the coal mine. When luxury consumers can't afford or won't pay for the expensive version, they'll buy something cheaper. Selective retailing? That's LVMH's travel retail business. Airports and duty-free zones, up 8%. Watches and jewelry, ultra-luxury categories, up 7%. Perfume and cosmetics, down 1%. The pattern is clear. Ultra-luxury to the extremely wealthy is fine. Everything aimed at the aspirational middle class is in decline. Let me spell out what this means. The business model Arnault built was predicated on one assumption: a global middle class with rising incomes and aspirational desire to own luxury brands. That middle class has hit a wall. In the United States, the only consumers buying luxury goods are the ultra-wealthy. The stock market surged in 2025. Wealthy Americans got richer. They're buying Cartier jewelry. They're buying Bulgari watches. They're buying Tiffany engagement rings. But middle-class Americans? They're not buying Louis Vuitton bags. They're not buying Dior handbags. They don't have the money. In China, the situation is worse. For the past 4 years, China has been in a deflationary spiral. Consumers aren't spending. Businesses are struggling. Wages are stagnant. The aspirational middle class that drove luxury consumption for the past decade has stopped shopping. They're not buying premium goods. They're buying cheaper versions or nothing at all. One analyst on the call noted that LVMH's fashion division recorded its 6th consecutive quarter of declining sales. Sixth. You don't get 6 consecutive quarters of decline in a healthy market. The market has structurally changed. Here's what management did that tells you everything you need to know. They stopped giving guidance. Last year, Bernard Arnault provided a reassuring message on current trading. This year, nobody dared to offer any indication at all. That's fear. That's management uncertainty. When a management team that has successfully navigated decades of market cycles suddenly goes silent on forward guidance, it means they don't know what's coming. Jefferies analysts wrote, and I'm quoting, "LVMH update was tough to unpack. The company seems wary." They said the company signaled continuing demand volatility and currency headwinds. Translation: we don't know when or if demand will recover. Now let me do the capital allocation autopsy. This is where you see the real failure. LVMH made an implicit bet. It bet that the aspiration model, the idea that middle-class consumers worldwide would persistently sacrifice to own luxury goods, would persist forever. The company organized its entire supply chain, its brand strategy, its geographic expansion, its manufacturing capacity around that bet. It invested billions in store infrastructure in Shanghai. It opened flagship boutiques in Chengdu. It built distribution networks across Southeast Asia. It hired thousands of sales associates, trained to sell to aspirational consumers. It created marketing campaigns specifically designed to make ordinary middle-class people feel like they could and should own luxury goods. What was expected? Continued growth in the middle-class consumer segment, emerging markets driving incremental sales, the aspiration model continuing to work. What actually happened? Middle-class consumers stopped buying. They don't have the income. They don't have the confidence. They don't have the desire. The opportunity cost. Every dollar invested in physical retail infrastructure in China, every marketing dollar spent on aspirational branding, every manufacturing capacity built for continuous volume growth, all of it is now working at capacity far below what was anticipated. Let me talk about the hidden trade-off that nobody wants to discuss. Discounting. If LVMH drops prices on Louis Vuitton bags to juice sales in a weak market, what happens to the brand? The entire value proposition of a Louis Vuitton bag is scarcity and prestige. If everyone is discounting, if sales associates are clearing inventory, the brand dies. So LVMH has a choice: maintain brand integrity and accept volume declines, or discount and destroy the brand equity that makes the products valuable in the first place. The company has chosen to maintain brand integrity, which means they're accepting volume declines, which means revenue is falling, which means the return on all that capital invested in manufacturing and distribution is declining. This is the capital allocation failure most people miss. Sometimes the failure isn't in the big bet. The failure is in not being able to escape the bet once it stops working. LVMH built infrastructure for a world in which middle-class consumers globally are spending on luxury. That world no longer exists, but the infrastructure is still there. The stores are still leasing. The supply chains are still running. The distribution networks are still operating. The company is now trying to cut costs to protect profit margins. They've brought in new creative directors at Dior and Celine to try to revive demand with fresh collections. But here's the thing: you can't design your way out of a macro consumer spending problem. You can make the bags prettier, but if the consumer doesn't have the money or the confidence to buy, the bag doesn't sell. Now, let me talk about a number that should terrify every LVMH shareholder. Analyst guidance withdrawal. The most telling moment in any earnings call is when a CEO stops providing forward guidance. Why? Because it means the CEO doesn't know what's coming. Bernard Arnault has run LVMH for decades. He's navigated economic cycles, market shocks, geopolitical crises. He knows luxury. And yet, after reporting earnings, his team is offering no guidance on future sales or demand. Why? Because they're staring at data that shows, first, China weakness has persisted for 4 years with no sign of recovery. The largest emerging market for luxury goods is stuck. Second, middle-class consumer spending in developed markets has collapsed. Wage growth isn't keeping up with inflation. Consumer confidence is fragile. Nobody knows when this ends. Third, the stock market rally in the US is boosting only the ultra-wealthy. Everyone else is treading water. When a management team can't predict the next quarter, that's not a statement about short-term volatility. That's a statement about structural uncertainty. Let me extract 3 lessons from LVMH's capital allocation failure. First, the aspiration model doesn't survive middle-class compression. LVMH built an empire on the idea that middle-class consumers would persistently save and spend on luxury goods. But that model depends on rising incomes, confidence, and aspiration. When those 3 things evaporate, when consumers are struggling, when confidence declines, when people stop believing in tomorrow, the aspiration model collapses. The lesson: when your capital allocation strategy depends on consumer psychology remaining stable, you're taking an enormous unhedged bet. LVMH took that bet. They lost. The lesson is, test whether your model survives when psychology shifts. LVMH's model didn't. Second, geographic concentration risk is invisible until it becomes catastrophic. LVMH has spent decades building infrastructure in China: manufacturing capacity, distribution networks, retail presence. The assumption was China's middle class will grow and spend on luxury forever. But China's middle class stopped spending. Now LVMH has massive fixed costs and excess capacity in a market where demand has evaporated. The lesson: when you build infrastructure for a specific market, you're making a 10-year bet on that market's consumer behavior. If that behavior changes, your infrastructure becomes a liability. LVMH didn't diversify geographic risk. They concentrated it. China was too good an opportunity to pass up. And now, they're paying the price. Third, success in a market creates cognitive bias that blinds you to the market changing. LVMH dominated luxury for 20 years. The aspiration model worked. Consumers bought. The company expanded. Money flowed. This success created a cognitive bias, the bias that the future would look like the past. Arnold and his team believed the aspiration model would continue forever because it had worked forever. But markets change, consumer behavior shifts, and when it does, the company that dominated the old market is often the last to see the new market. The lesson: success is dangerous. Success breeds confidence. Confidence breeds complacency. Complacency breeds blindness. LVMH dominated so thoroughly that they couldn't imagine the model breaking. And when it did, they had no contingency plan. Here's my closing conviction. LVMH is in the middle of a structural decline in its core business, not a cyclical decline. Structural. The fashion and leather goods division, the profit engine, has declined for 6 consecutive quarters. Management is offering no forward guidance because they don't know when or if demand will recover. China remains weak. The middle class isn't spending. The ultra-wealthy are buying, but not enough to offset the volume decline from the aspirational segment. The company could cut costs further. It could close stores. It could reduce manufacturing capacity. But at the end of the day, those are defensive moves. They don't solve the core problem. The aspiration model that built the empire is broken. LVMH has options. It could pivot to ultra-luxury exclusively. Cartier, Bulgari, and Tiffany are performing well. The company could retreat from geographic markets that aren't working and concentrate on ultra-wealthy consumers in developed markets. But that's not growth. That's managed decline. The harsh truth is this: the world that made LVMH great, a world in which middle-class consumers globally were growing richer and spending on aspirational luxury, that world is gone. We're in a world in which the middle class is struggling, confidence is weak, and only the ultra-wealthy are spending. LVMH built the greatest luxury empire ever created. But the model that built it has expired. And a company that dominates one era often struggles to dominate the next. Here's the sentence you'll remember: The luxury company that succeeded by making aspiration scalable is now facing a world in which aspiration itself has become a luxury the middle class can't afford. Now, towards last article, Scotts Miracle-Gro strikes deal to sell cannabis supply unit. Scotts Miracle-Gro just announced it's selling its Hawthorne gardening cannabis supply business to Vireo Growth. The stock response is, barely move. And that tells you everything you need to know about what happened. A business that once drove a stock from $40 to $250 is now being treated as a relief. Getting rid of it feels good. This is a capital allocation story about success that plants the seeds of failure. This is about a founder's son who recognized that winning in the wrong market was worse than not playing the game at all. Let me explain what happened and why it matters to how you think about capital allocation, optionality, and when to admit a bet was wrong. Jim Hagedorn runs Scotts Miracle-Gro. The company makes lawn and garden products. For decades, Scotts owned a predictable, profitable, boring business: seed, fertilizer, grass treatments, garden tools. The company generated steady cash flow. Shareholders got dividends. Valuations were modest but stable. That was the core business. Then came the pandemic, and a coincident opportunity. Marijuana was becoming legal in more and more states. Cannabis consumption surged. And Scotts saw something that most people missed. If consumption is surging, someone has to supply the growers. Someone has to provide the lights, the nutrients, the equipment, the cultivation systems. That someone could be Scotts. So Scotts invested heavily in building out Hawthorne gardening. Started the business more than a decade ago, but really leaned into it during the pandemic. Invested capital. Built supply chains, hired teams, positioned Hawthorne as the de facto supplier to commercial cannabis growers across America. For a few years, it worked. It worked brilliantly. Hawthorne became a profit engine. Cannabis growers needed equipment. Hawthorne supplied it. Margins were good. Growth was strong. And investors loved it. The stock climbed. One story, two stories, from $200 to $250. Peak in 2021. But here's the thing about capital allocation in new industries. You're making a bet on an industry trajectory, not just on your operational excellence. And the cannabis industry's trajectory changed. What happened was structural. The legal cannabis industry matured. New growers entered the market. Price competition emerged. And more importantly, consumer demand growth slowed. People assumed that legal cannabis would grow exponentially forever. It didn't. It plateaued. Growth stalled. The market became competitive. Consolidation accelerated. Smaller growers went bankrupt. Larger growers consolidated. Equipment suppliers got squeezed. Hawthorne's sales started declining. The trajectory that Scotts had built for switched from growth to contraction. But here's the capital allocation problem. Scotts is a lawn and garden company. Investors own Scotts stock for boring, predictable, cash-generative lawn and garden business. They don't want cannabis exposure. They don't want cannabis volatility. They don't want to be hostages to the cannabis market's ups and downs. So what happened to the stock? It got punished twice. First, Hawthorne's sales declined. Second, investors sold Scotts because they didn't want cannabis exposure in the first place. The stock crashed from $250 down to the low 40s. That's roughly a 70% decline. In roughly 18 months, 3 years of net losses followed. The company's core lawn and garden business was solid, stable, profitable, but it was being held hostage by a cannabis business that was collapsing. This is the most important insight in capital allocation. Sometimes a business that was right at one moment becomes catastrophically wrong at the next moment. And holding on to it doesn't give you optionality. It destroys your core business's valuation. Scotts had 3 choices. First, double down on cannabis. Double down on the bet. Hope that eventually the market recovers. Invest more capital. Try to consolidate the market. Build a cannabis empire. That wasn't going to work. The cannabis industry was consolidating in the wrong direction for a supplier. Growers were consolidating. Equipment suppliers were getting margin compression. Investing more capital would just lose more money. Second choice, liquidate Hawthorne. Sell it to someone, take the loss, and move on. Exit completely. Third choice, divest but maintain optionality. Sell the operating business to another operator who can run it better. Take a minority stake, maintain a board seat, continue to provide manufacturing and R&D support, but remove the operating drag from the core Scott's business. Jim Hagedorn chose the third option. And here's why that matters. On screen right now, you're seeing the stock price history. $250 in 2021 when Hawthorne was the growth story. Then, the decline. Low 40s in 2230 when the market realized cannabis wasn't going to grow as expected. Then the recovery. 62.80 as of Wednesday after announcing the Hawthorne sale. That's 60% off the peak, but stabilizing. The company has returned to profitability in fiscal 2025. The core business is working again. The deal structure is brilliant because it maintains optionality without the drag. Scotts is receiving a 13% stake in Vireo, not a controlling stake, just a minority stake. That means if Vireo figures out how to run the cannabis supply business profitably, Scotts benefits from the upside. If Vireo fails, Scotts' limited downside is a small equity position, but the core Scotts business is no longer hostage to the cannabis industry's trajectory. Additionally, Chris Hagedorn, Jim's son and longtime leader of Hawthorne, joins Vireo's board. That means Scotts maintains influence and insight. Scotts continues to provide manufacturing and research and development support to Hawthorne. That means Hawthorne still benefits from Scotts' expertise. Scotts continues to generate revenue from the relationship, but the operational management is with Vireo, a pure-play cannabis operator that investors actually want to own. Jim Hagedorn said something telling: "This is not an evacuation of Hawthorne and throwing it to the wolves. We're very comfortable with Vireo's plans." Translation: we're not abandoning the opportunity, we're just recognizing that we shouldn't be the operator anymore. The cannabis market doesn't want Scotts to be their supplier. Investors don't want Scotts to own cannabis, but we'll maintain a stake and stay involved because we still think there's value. Now let me do the capital allocation autopsy. What was expected? When Hawthorne was built and ramped during the pandemic, the expectation was obvious. Cannabis would legalize progressively. Consumption would grow. Growers would consolidate and professionalize. A professional supplier like Hawthorne would become essential infrastructure. The business would compound at high rates for a decade. What actually happened? The cannabis market did legalize. Consumption did grow initially, but then growth plateaued. The market became competitive. Growers faced price pressure. Margins compressed. Industry dynamics shifted from "growth is all that matters" to "profitability is what matters." And Scotts, as a supplier, doesn't benefit from profitability in the same way a grower or retailer does. Scotts just loses margin as the industry matures. Opportunity cost? Every dollar invested in building Hawthorne was a dollar not invested in the core lawn and garden business. The core business generates stable, predictable, high-quality earnings. The cannabis business generated volatile, uncertain earnings. Investors penalized the stock for the volatility more than they rewarded it for the upside. The company would have been worth more if Hawthorne had never been built. Hidden trade-offs? The big one: management distraction. Building a cannabis company requires different expertise, different relationships, different regulatory knowledge than managing a lawn and garden business. Jim Hagedorn and his son Chris had to split their management time and attention. The core business wasn't getting the focus it needed. This is the most important capital allocation lesson. Success in the wrong market is worse than failure in the right market. Hawthorne was operationally successful. It grew. It was profitable. It supplied equipment people needed, but it was structurally wrong for Scotts. It attracted the wrong investors. It created the wrong volatility profile. It distracted management. Holding on to it made the entire company worth less, not more. Think about the incentives here. Scotts shareholders want Scotts stock. They want lawn and garden cash flow. They want dividends. They want predictability. Cannabis investors want cannabis exposure. They want volatility. They want growth speculation. When Scotts owned both, it satisfied neither group. Lawn and garden investors thought the company was too exposed to cannabis risk. Cannabis investors thought the company wasn't focused enough on growth, so the stock got punished from both directions. The genius of the deal is that it aligns incentives. Scotts is now a lawn and garden company with a small cannabis bet. Investors can own Scotts for what they actually want: stable lawn and garden cash flow. Vireo is a pure-play cannabis operator. Cannabis investors can own Vireo for what they actually want: growth and cannabis upside. Both companies are now positioned to be valued correctly. There's another angle here that matters: Family dynamics. Jim Hagedorn built Scott's. His son Chris built Hawthorne and has led it since inception. You'd think a founder would want to keep everything together. Build an empire. Let the son run a division of the family business. But Jim made a different calculation. He recognized that the best thing for both the company and his son was to separate them. Give Chris the independence to run Hawthorne with a partner who's focused on cannabis. Free up Jim to focus on the core business. And maintain a stake in Chris's venture so the family still benefits if it works out. That's sophisticated capital allocation thinking. It's saying, I love this business. My son built this business. But keeping it inside Scott's is making everyone worse off, including my son. Now let me extract 3 lessons from Scott's capital allocation decision. First, success in the wrong market creates a valuation penalty greater than the operational profit. Hawthorne was operationally successful. It was profitable. It grew faster than the core business. But it was in the cannabis market which investors didn't want Scott's to be in. The valuation penalty, the discount investors applied to the stock because of cannabis exposure, was larger than the profit Hawthorne generated. At some point, a business that's profitable but creates an unsustainable valuation discount should be divested. That moment came for Scott's when they recognized that the core business was worth more separately than together with Hawthorne. The lesson is, operate in the markets investors actually want you to operate in. If your success is creating a valuation penalty, that success is a liability. Second, optionality without operational control is the best risk-adjusted capital allocation. Scott's maintained a minority stake and board representation without operating responsibility. That means Scott's gets upside if Vireo figures it out, but doesn't have downside if the cannabis market declines further. This is a sophisticated capital allocation move. Most companies make all-or-nothing bets. They either own a business completely or not at all. But the best capital allocators maintain optionality without the drag of operational control. You want exposure to the opportunity without being responsible for the outcome. Scott's found that sweet spot. Third, when incentive alignment is impossible, separation is optimal. Scott's shareholders want one thing. Cannabis investors want another. You can't satisfy both incentives within a single corporation. The stock gets punished because the corporation is trying to maximize for 2 different constituencies simultaneously. The solution: separate the businesses so each can optimize for its own stakeholders. This is why conglomerates are typically valued at a discount to their constituent parts operated separately. Scott's realized that being a conglomerate was destroying value. By separating, both businesses can be valued fairly according to their own fundamentals. Here's my closing conviction. Scott's Miracle-Gro made the right capital allocation decision. The company recognized that a business that was right at one moment had become wrong at the next moment. Rather than holding on to it out of attachment or pride, the company executed a surgical separation, maintaining optionality through a minority stake and continued business relationship, but removing the operational drag from the core business. The stock response, barely moving on positive news, tells you that investors had already priced in the cannabis discount. Removing it should lift the stock over time. But the real victory here is the recognition itself. In business and capital allocation, the most valuable skill is knowing when to quit, not knowing how to succeed. Everyone wants to be good at succeeding. The real skill is knowing when you're succeeding in the wrong market and having the discipline to step back. The lawn and garden business is boring, predictable, cash generative. It will never make headlines. It will never create billion-dollar value from a single product. But it's the business Scott's should own. And by letting go of Hawthorne, Scott's is free to actually focus on what it should be doing. Here's the sentence you'll remember. The best capital allocators don't hold on to losers. They recognize when winners are holding them back. This is Avi. Like and subscribe. On to the next.